Thank you for coming to our Create Great Credit class. My name is JC Finley, your presenter, and we'll go ahead and get started. So first, before we dive into our Create Great Credit content, I like to start with what is a credit union. So if you're not familiar with what a credit union is, we provide not-for-profit banking products, loans, and services to our members. Credit unions are owned by their members, so you have a say in how the credit union is led and operated. Every member is an owner, so it's a democratic financial institution where members vote for the board of directors to have a say in how the credit union is run. The overall difference between a credit union and bank is credit unions are for people, not profit. A little bit about Zing Credit Union and who we are. Our mission is to educate, deliver, and achieve. We want to have a well financially educated community so they can reach their financial goals. As I mentioned, we are a not-for-profit financial institution, and we have been serving Denver since 1934. We were founded by 5 City and County of Denver employees. This class is a part of our free financial education program that was started back in 2005. That includes our live classes, recorded classes that can be found on our website at myzing.com/recordings, free one-on-one personalized financial coaching, and also our e-learning classes that are available in both English and Spanish on our website. So diving into our credit, to familiarize you with credit terminology and vocabulary, we're going to discuss 4 people's credit situations. So first here we have Brad. Brad has 0 trade lines or lines of trade. And when you hear the term trade line, that just means any open and active loans, credit accounts, or lines of credit that are being reported to the credit bureaus. So you'll be able to find these in your credit report. We'll talk about 2 different loan types. The first one is revolving loans. These things are like credit cards, overdraft lines of credit, home equity lines of credit, and other lines. Basically, you have a certain limit and you can use up to that limit each month, and then you pay that balance down when you get your monthly statement. Then there's installment loans. These are things like an auto loan, mortgage, personal loan, where you borrow a certain dollar amount, and then you'll pay that loan back over a specified term. So basically you make your same monthly payment for a certain number of years or months until the loan is completely paid off. Lastly, inquiries. Brad has had 2 inquiries in the last 6 months. So there's 2 inquiries we will discuss. First one is soft inquiries. Soft inquiries is when someone checks your credit report or your credit score, but it does not impact or hurt your score. This is oftentimes for background purposes, maybe for a new apartment or for a new job. A soft inquiry might happen to your credit score. A hard inquiry is a little bit different. Hard inquiries are where we do see a decrease in your credit score. I always say anytime you apply for a new line of trade, whether it's an auto loan, mortgage, credit card, expect your score to drop about 3 to 10 points. Next, we have Greg. Greg has some unpaid collection accounts. We're talking about collection accounts. Those are debts owed to a lender or a company that have then been sold to a collection agency after 180 days of non-payment. So oftentimes it has to be 180 days late, and then it is sold to a collection agency. When you have a collection account, it will display as a new additional negative account on your credit report. So it is beneficial to you to repair that late payment or delinquency with the original company or lender rather than letting it go to a collection account. Any collection account is damaging regardless of the balance owed. It could be $25 or $2,500. Both will be damaging to your credit score. And then on the other side of that, paying off a collection account will significantly improve your credit score, which is awesome. Greg has a length of credit history around 72 months, and the longer you have a positive credit history, like on-time payments, the better off your credit score will be. Now we have Helen. Helen has 39 trade lines and 24 paid accounts. I would assume Helen is some sort of business owner. I believe the national average for the number of trade lines per American is normally about 3 to 5. So this is a lot of trade lines here, probably a business owner. And when we say she has 24 paid accounts, that just means everything's been paid on time. Current on her accounts, including mortgage, that means she has no late payments. Helen has about $10,500 in credit card balances, but her total available revolving credit card is at around $70,000. So if we divide that $10,500 by $70,000, her credit utilization is about at 15%. No delinquent accounts and no late payments. So that's good to hear. If Helen were to have a late payment reported to the credit bureaus, it can stay on your credit report for up to 7 years. So I don't want that to sound too scary. Oftentimes you will see a drop in your credit score. It will stay on your report for 7 years, but your score should bounce back as long as you continue to pay all your other bills on time, and your credit worthiness isn't out of whack. You're not maxing out your credit cards and so on. Typically, late payments are reported to the credit bureaus after being 30 or more days late, but not always. So that is kind of a grace period that you have around 30 days. Once it is 30 days late, you can expect it will be reported to the credit bureaus, and expect to see a drop in your credit score there as well. And lastly, we have Sarah. Sarah filed for bankruptcy in 2019. Bankruptcy is a last resort legal process, and in the United States, medical debt is the top reason for bankruptcy filings. Sarah has had 9 inquiries in the last 6 months, so that means she's applied for credit 9 times in 6 months. I would say that's quite a bit. I recommend only applying for credit when you really need it, maybe once or twice a year or once every 6 months. Sarah is maxed out on all credit cards. When we say maxed out, that means at or above the limit of a credit card or a line of credit. And we're talking about being maxed out. It also refers to credit utilization. That term credit utilization means the percentage of the limit used on a revolving credit card. So if Sarah's credit card is $1,000 and she has a $100 balance on there, that means that she's used 10%. In this case, if she's maxed out, she is at 100% or more, or at $1,000 or more if she has a $1,000 credit card. But one good thing for Sarah is she has not missed a payment since bankruptcy. So that is one good thing she has going for her there. Now, what is the best definition of credit after listening to those people's scenarios? Letter A, credit is a number that lenders use to determine whether to give you a loan or not. Or B, credit is confidence in a borrower's ability and intention to repay. And the answer here is B. Letter A's definition is actually for a credit score, that physical number that lenders use. But the overall definition of credit in the concept is just knowing if someone's going to be able to repay. Now, diving into credit reports. What's in a credit report? A lot of information here. So we're going to look at a sample credit report on the next slide, but you will find your personal information. This will include your name, social security number, birth date, addresses you've lived, and phone numbers. It will also include any loan account information. These are accounts that have been open or closed in the last 7 to 10 years. It will include dates these accounts were open and closed, your payment history, credit utilization, account balances, and loan payment statuses. It will include any public records, so bankruptcies, foreclosures, tax liens, and civil judgments. Inquiries, also called hits on a credit report, which is anytime your credit report or score is pulled. A few things that are not included. It will not include any income or bank account information, race, or employment status. Please note that businesses, including lenders, do not have to report to the credit bureaus. So that is why it is so important whenever you get a new credit card or loan to ensure that the bank or credit union or lender is reporting to the credit bureaus, because if it's not in your credit report, it's not helping your credit score. There are 3 separate credit bureaus, and they are for-profit companies. They are Experian, TransUnion, and Equifax. All right, here's that sample credit report I was talking about. So you're going to look for 5 information zones when you pull your credit report yourself. Yours will probably be several pages long just to include everything here, but this is a shortened up example. So area 1, personal information. You see we have name, address, date of birth, social security number. It would also include any phone numbers here. 2, public records or legal items. In this example, we do not have any. Number 3, collection items. This is an important area to look out for on your credit report. So you can see here we have one collection from July 2018 for $500. When you pull your own credit report, there should be some contact information there so you can reach out to the collection agency and get that resolved or paid off. Number 4, this is our trade line or loan account information. So you can see we have 3 things here: a bank card, auto loan, and I'm going to guess a retail card. You can see the date opened, date reported, the highest credit limit, the balance, and then the status. Lastly, we have our inquiries here. The first one is for a cell phone provider. This was probably a soft inquiry. And then we have a card issuer on 6/15/2017. This was probably a hard inquiry where they did see an impact in their credit score. One thing to note is mistakes are common on credit reports. About 20% of Americans have some sort of error on there. It could be something small like, your name's misspelled or your address isn't up to date, or it could be more serious things like accounts on there that aren't yours. I highly recommend going to annualcreditreport.com for a free copy of your credit report every 12 months. So if you pull all 3 of your credit reports today on September 21st, you won't have access to these credit reports again until September 21st of next year. So you are able to pull all 3, one from Experian, one from TransUnion, and one from Equifax. You can pull them all at once, or you can split them up throughout the year, whatever works best for you. You can also dispute any errors and inaccurate information and have it removed for free directly through this website. Now, looking at when is a credit score important? So first we have a checking account. This one's in the middle because it really depends per financial institution if they will check your credit score for a checking account. At Zing, we do not do a credit check for account opening. Getting employment. This one is also in the middle, and it really depends on your career path and what industry you're working in. I know for my role at the credit union, my credit score was checked, but at previous roles, it was not. A rent-to-own store. This one also goes in the middle. Some do a credit check, some do not. So it really depends on the facility you're going to. Now, renting a place, a credit score will be important. The landlord or leasing office wants to see consistent repayment behavior so they know that you're going to pay your rent on time. Auto loan, absolutely, credit is going to be important. You need to have a good credit score to get an auto loan, and the higher your score, oftentimes the lower your interest rate will be, helping you save money in the long run. A mortgage or a home loan, absolutely credit scores will be important. For most of us, when we buy a home, it's one of the largest purchases we make. So it is important to have a good, strong credit score for getting ready to buy a home. And then lastly, on the credit score is important side, auto insurance. Having a good credit score can actually save you money on how much money you're paying for auto insurance every month. That was something I did not know before taking this class. Now, credit score is not important for payday loans. Although it has the name loan in there, they do not do a credit check for payday loans, therefore having very, very high interest rates. And a pawn shop. Your credit score is not important or checked at a pawn shop. Now, diving into FICO credit scores. These are the most commonly used credit scoring model. So FICO is used by about 90% of lenders throughout the United States. These scores will range from 300 as the lowest to 850 as the highest score possible. And remember that your score is based only on the information in your credit report. So that's why it's so important to look at those credit reports frequently. You will have 3 FICO scores, one from each credit bureau, and they will vary a little bit from each bureau to another. So they probably will not be all 3 exactly the same across the board. So expect a variation of maybe 1 to 10 points between each bureau. And FICO scores are based on 5 different categories. We're going to go through those on the next slide here. And the importance of those categories will vary by person depending on their credit profile. So how many lines of trade are you using? How long is your credit history? Have you had late payments? And so on. So factors that determine a FICO credit score. Number 1 is payment history, which is 35%. When we're talking about payment history factors, we're looking at things such as how recent was the most recent delinquency, collection, or public record item? And how severe was that delinquency? Was it 30 days or 90 days late? How many credit obligations have been delinquent? So how many late payments have you had across your credit lines? And one thing to note is on-time payments to installment loans help more for your credit score than on-time payments to revolving loans. Building credit will take longer if you only have one open line of credit, but we don't recommend going into costly debt to build credit. There are many affordable ways to do so that we'll cover soon. Next, credit utilization. This is 30% of your FICO credit score. This category can also sometimes be called outstanding debt. So collections are taken into consideration here. And also your balances on your credit cards are taken into consideration here. So it's important to not use too much of that credit card limit. I recommend using 10% or less of your credit card limit for the highest score possible, or up to 30% of your credit limit to maintain a good credit score. Length of credit history is 15%. So credit history factors look at how long have accounts been established, the average number of months accounts have been open. So you don't want to open a lot of credit at one time because that'll really shorten up the average length of your credit history. Amounts of new credit, this is 10%. So this is looking at your inquiries. So the number of inquiries you've had in the last 12 months. New accounts, the number of trade lines you've opened within 1 year's time. And then lastly, types of credit and use. This is also 10%. So this is looking at having a mixture of both installment loans and revolving loans. Now, thinking back to our 4 individuals we discussed at the beginning, we had Brad, Greg, Helen, and Sarah. Who do you think would have the highest credit score? Helen. Helen would have had the highest score. She was on time for all of her accounts. Everything was paid. She had lots of trade lines, and her credit utilization was around 15%. And oftentimes I'll get the question, is having a credit score the most important financial skill? And what we like to say at the credit union is credit is an important tool in your money management toolbox, but it's not the only tool available to you. It's important to manage your money in a way that helps you reach your financial goals and doesn't put you into debt. So, in this example, we're going to look at the dollar impact of a credit score for an auto loan. And just a note, these are not our current loan rates, but just an example for the purpose of this class. So you can see here, if you have a credit score of 740 or higher, you're going to have about 4% APR. If you have a lower credit score, maybe 600 to 639, you're looking at 17.25. So big difference there. So we took someone that had the best score possible versus the lowest score possible. The loan length is $10,000 over the course of 5 years. This would probably be like a typical used auto loan. We see their monthly payments differ by about $65 a month. So when I originally saw this, I was like, okay, $65 a month isn't too bad. But when we look at the total interest paid over the life of the loan here, we're looking at close to $4,000. I'm sure all of us could sit here and think of $4,000 of things we'd rather buy or vacations we'd rather spend that money on than interest on our car loan. So this is a pretty dramatic example, but this does go to show how much money you can save by having a good, strong credit score. Now, can you have a good credit score without using credit? The answer here is no. Someone who does not use credit would just have no credit score. They wouldn't have a 300 or a 400 or a low score. There would just be no score available. You need regularly reported on-time payments to build credit. Normally, it takes about 6 months to build a strong FICO score. So you will receive a score after your first month or 2 of credit building. We like to say it takes about 6 months to build a solid score. And you can be considered a risky borrower if there's no history or data of repayment behavior. That's really what lenders are looking at the most when they pull your credit report, is just have you paid back other lenders or other companies on time? So I really like this example. Here's how 5 different people with different FICO scores would see their scores impacted by a range of events. So feel free to just look at these individuals as I'm talking. So everyone has a different area, different percentage of credit utilization. We can see that Sophia and Mike have higher credit utilization there. Everyone has different revolving loan balances. It looks like David and Maria, even Sophia, don't have as high of revolving balances. Credit history. We can see that Sophia and David are newer to using credit, only 8 years and 2 years of history. We can see that Mike and Maria have some recent inquiries, so they've applied for credit. And Sophia does have some delinquencies or late payments. So based off of how their credit makeup is, you can see what their reflected FICO score might be there, highlighted at the bottom. On the next slide, we're going to look at a series of credit actions to see how their score might be impacted. All right, you can see everyone's names still here at the top, and they are color coded to make that easier to see. So on the left-hand side, we have some credit actions. So first one here, missing a payment by 30 days. We can see everyone's score here takes a drop. And then if we go down to the next one, missing a payment by 90 days, you can see here that this makes a bigger difference in the score and how negatively impacted it is. So you can see that missing a payment by 30 days is better off for your score than missing a payment by 90 days. Next, reducing your revolving account balances by 25%. So that means paying off 25% of their credit card bills. You can see everyone's score goes up here. Taking out a new personal loan for $5,000, everyone's score drops roughly 5 to 10 points. And then lastly, maxing out all credit cards. You can see between missing a payment by 90 days and maxing out credit cards, those were two of the most negatively impacting actions regarding your credit score. Building or rebuilding credit affordably. A few strategies to touch on: for the highest credit score possible, keep revolving loan balances like credit cards up to 10% of your credit limit at all times. Set alerts on your phone or on your computer, or whether it's a post-it note, whatever works best for you, to stay on track. Or if you have a high balance on there, pay that balance down multiple times a month so you're not using more than 30% of your limit. Lastly, pay any credit card balances in full every month to avoid paying interest, which is a finance charge. There used to be this myth that you had to carry a balance on your credit card to increase your score, and that's simply not true. The best way to use your credit card is pay the balance off in full every month. A few tools that we'll discuss today for building or rebuilding credit are secured credit cards, credit builder loans, and credit cards with no fees or very low fees. So first, the credit builder loan. The credit builder loan is great because you can build savings and credit simultaneously. We use payment history to build credit. It is set up like an installment loan. Two huge benefits. Number one, no money upfront needed. That is a big barrier for some people, is to have money up front for secured credit cards. This alleviates that barrier, so we no longer have to have money up front. And then there's no credit qualification required. So it doesn't matter if you're building credit for the first time, or maybe you're rebuilding credit after a bankruptcy. There's no credit qualification required. You can set the loan for $500 or $1,000. You get to choose, and it's over a 24-month term. So here's a flow chart to walk us through the credit builder loan. First, a member applies for the loan with no credit pull. We will open a certificate of deposit for that member. So let's say you open the $500 credit builder loan for 24 months. We would put that $500 in a certificate of deposit. The member then pays back the loan in monthly installments. So in this example, you'd be paying about $25 a month for 24 months. At the end of the loan, you will get back that $500 plus any interest it earned sitting in that certificate of deposit. So basically, you make on-time payments for 24 months. At the end of the 24 months, that's when we give you that $500 or $1,000 that you selected. So you've not only built your credit over those 2 years, you also have built your savings. Next is our starter Visa credit card. This is for someone with no previous credit history, so you've never used credit before. You must also have a verifiable income to qualify. So those are the two things we need for this one, is no credit history and a verifiable income. We have to see that you can pay off the credit card every month. Starter credit cards are preset by the limit is preset by the financial institution. Ours are set at $300. We don't want someone getting into really costly credit card debt with their first credit card. So that's why we have a lower limit. There is no security deposit or money down for this one, and we offer financial education to answer any questions and to ensure that the member is going to be using the card responsibly in a way that's building their credit score. Next, we have our secured credit card. For the secured card, you do have to put up your own funds in a frozen savings account to secure the card. So basically, a 1-to-1 ratio of frozen funds in a savings account will match the limit of the card. So for example, if you want a $500 credit card, you have to put $500 into this frozen savings account first. That is not a fee. The credit union will not keep that money. It's basically just there in case you were to max out your credit card and then not make any payments. The minimum balance will vary. We do have a minimum of $250 for the credit card. The reason for that is because we want someone to be able to use the card in a way that's going to help their score. If we're talking about 10% of $250, that's only $25 a month. Interest rates will vary per credit card. As of September 2022, our credit card interest rates are at 12.99%, regardless of credit score. Watch out for any fees, such as balance transfer fees or cash advance fees or annual fees. And sometimes no credit pull is required for secured credit cards at some financial institutions because you're putting up that security deposit. A few strategies for good credit. Check your credit report at least annually for free at annualcreditreport.com. Number 2, pay bills on time and pay off collection accounts. These two alone are about 65% of your FICO score. Keep amounts owed low on your revolving lines of credit, like 10% or less of your credit limit for the highest score possible, or up to 30% of your credit limit to maintain a good credit score. Keep your credit history as long as possible. Don't be opening and closing accounts frequently. Keep inquiries to the necessary, so only apply for credit when you really need it. And then lastly, having a mix of credit, both revolving and installment loans. So as we wrap up today, we're going to go through some frequently asked credit questions. So does my debit card or checking account impact my credit score? The answer here is no. Some institutions will do a credit check to open a checking account. At Zing, we do not. But overall, your debit card does not impact your credit. Now, what is the range of credit scores? The answer here, FICO credit scores range from 300 as the lowest score to 850 as the highest score. What is a good credit score for getting a new loan or a credit card? This is a really popular question. At the credit union, we say scores of 700 and up typically receive the best rates from lenders. Those are considered good credit scores. The higher credit score you have, the better. How can I build my credit score? There are a lot of different tools. At Zing Credit Union, we have credit cards, secured credit cards, and credit builder loans to build credit. Now, where can I see or find my credit score? There's a few different places out there. Experian.com will offer you a free copy of your Experian FICO score and Experian credit score, or credit report once a month. CreditKarma.com also offers free credit scores, and we also have free credit monitoring on the Zing mobile app. Can I add my child to my credit card to start building their credit? Yes, you can, but they must be 18 years old. You have to be 18 to have access to credit. Why are my credit scores different when I look on different websites? Which one's real? There are two different FICO scoring systems, or excuse me, there are two different credit scoring systems out there. There are FICO and Vantage scores. Like I said, FICO is used by about 90% of lenders. Credit Karma does use the Vantage score. Basically, that just means that the pie chart that we went over today is a little bit different for Vantage scores than FICO scores. Also, not all lines of trade report to all three credit bureaus, causing a slight difference in the scores. That's why it's always important to ask a lender or company, which credit bureaus do you report to? And where can I access my credit report for free? Annualcreditreport.com would be the best place to access your credit report, and you can pull all three of your reports there. If you do have any other questions, feel free to reach out to me, JC Finley, J Finley, Finley at myzing.com to schedule financial coaching, or if you'd like more personalized credit help, feel free to reach out to us. Thank you for watching our Create Great Credit class today. Have a good day.